Hi, and thanks for watching. My name is Steve Olson with Vision Equity here in Indianapolis, Indiana. We're here to talk about turnkey real estate and why we feel like this market is the number one market for real estate investors right now. So let's get in right into it and let's talk about who we are and why you should care about what I have to say here. As you know, if you've not been living in a cave for the last 3 or 4 years, here in the United States, we've had a little bit of a mortgage meltdown. We've got a lot of foreclosures on the market in many areas of the country, and that's essentially where Vision Equity got its start in about 2005. Back then, the boom was still in full swing in a lot of areas. However, some of the symptoms were starting to manifest themselves, especially in the southeastern United States in Florida, where we were located at the time. So we got into what was called the bulk REO market, where you would buy a big pool of homes at a time from a bank like Wells Fargo or Citigroup or Fannie Mae or something like that. And you could then turn around and sell that whole package of homes to another investor, or you could break it off in pieces and such, and you could make some really good profit margins. Because the way you would look at that, let's say you had a pool of 100 homes. 10 to 15% of that pool would be your really good properties that you would make a lot of money on. The rest of it was mediocre, and then another 10 to 15% was pure junk. Stuff that had been bulldozed, it's vacated, it's in a horrible area. The only thing that you could do with it would be to donate it or something like that, to just get it off of your books. So we did about 6,000 homes in about a 5-year period through this method. And it worked really well for us. We really liked it. However, in 2009, once the whole country had completely melted down real estate wise, this market in the bulk side of things wasn't very profitable anymore. The banks owned too much real estate to not be able to think about this in a more intelligent way. They had to price these properties more efficiently, so when you got a bulk package of, say, 100 homes, that 10 to 15% of the really good ones was almost gone, and the 10 to 15% of the really bad ones grew. It got to be 20, 30% more and more and more, so you just really couldn't do anything in that market anymore. So we made our exit from bulk REO in 2009. But it did give us unparalleled experience. There isn't a situation in residential real estate that we haven't seen. When you do 6,000 homes, you've seen it all. Any kind of title issues, lien issues, tenant issues, we've seen it. So we thought at that time, what was the next step going to be? What were we going to do with our money? What was the most intelligent play? And you, like me, have probably heard that conventional wisdom would say a commercial crash is going to follow a residential crash by about 2 years. It's just kind of the cycle of how things happen. Now, if you've been watching things like I have, you know that commercial has not melted down to the point that many thought it would. In fact, commercial pricing isn't that great. It's better than it used to be, but it's held up comparatively well if you put single-family residential real estate to the side of it. When we found out why that was, is Congress changed a lot of the banking laws as to how a bank accounts for a bad commercial loan on its books. These guys didn't have to unload the foreclosed commercial loans as quickly. Therefore, there wasn't a glut of commercial property on the market. Therefore, there wasn't a commercial crash. So we had to consider at that point, well, if it's not going to be commercial, what are we going to do? Because this commercial crisis has not been nearly as severe as the residential one. So we said, well, the money's not there in bulk REO, it's not there in commercial, but it could be there in more of a laser-guided approach to the residential REO. Just take a market that works really well and buy in that area, hold those properties for passive cash flow. That was the plan. So we researched over 30 different metropolitan areas, and when the preliminary research came in, we narrowed it down to 10. We did purchasing and testing in those 10 areas, and there's a lot of things that we took into account. Number one was geography. Was this place in a good geographical area? Number two was the local economy. Was the local economy healthy or comparatively healthy to the rest of the United States? Number three was the local government. Was it friendly to investors, or did it routinely throw up obstacles in the way of investors? What about historical real estate data? What had that market done over the last 20 or even 30 years? What could we expect over the next 20 or 30 years in that market? What about home prices versus rental rates? How much did we have to spend to get a corresponding amount in rent? And what about on paper versus reality? Sure, the research that we did could look good, but after our beta testing came in, did we get the kinds of numbers that we thought we were going to get? These were the factors that went into play when we selected these markets. And interestingly enough, Indianapolis wasn't even in the top 10 at the beginning. It got there because of some of the beta testing that we did and ended up in the top 10, and it was always sitting there. It was always glaring out at us from the paper as good, solid numbers time and time again. And we believed in the market so much that in 2010 we relocated the entire company from Tampa to Indianapolis to just do single-family properties in this market. And a couple of reasons why is, number one, the geography was great. Indianapolis, and you can see on the map on the left side of the screen over there, is known as the crossroads of America. Big freeways, big national freeways go through here, and it's always been a big trucking and transportation hub that's kept the economy fresh for quite a while. The local economy is solid. The unemployment rate is about 1% below the national average. You want to have good, credit-qualified tenants who can pay their rent on time every month. Yeah, there's a lot of markets out there where you can buy properties for cheap and where property managers will quote you high rents. But how long are those people going to stay? Are you going to have reliable tenants? You can find a tenant for any property, but is it a good tenant? That's the key. We looked at the local government in Indianapolis. It was favorable towards investors. They took good, reasonable regulations to enforce laws against people who were letting properties deteriorate, but for investors who were trying to do the right thing and get good quality properties into good neighborhoods, the government wasn't hassling them and throwing up roadblocks that made the market really unpredictable. That wasn't the case in other markets that we researched. Historical real estate data. If you look at a graph of Indianapolis property values over the last 20 or even 30 years, you'll notice that those values have been relatively stable. If there's a decline, it's very mild and it's over a long period of time. If there's an incline, it's very mild and it's over a very long period of time. So the property values are a lot like the land out here, pretty flat, a little bit of variance here and there, but it's nothing scary, it's nothing unpredictable. Whereas other markets that we looked at, you had to put on a neck brace after you were done looking at the chart because it whipped your head up and down so fast as the values have fluctuated so drastically. So we liked it for an investor that wanted a good, steady, predictable rate of return. We also liked the prices versus the rental rates. The average rent that we get for our properties in Indianapolis is just over $700 a month. And we have to spend correspondingly little money to achieve that rental rate. Whereas in other markets, you may have to spend much more money to get that amount of money in rent. And we are at a unique time in the history of the country here where in markets like Indianapolis, you can do that. Before, it was just not possible. With what you had to buy a property for and maybe get a mortgage on it, for example, the amount of rent that came in would not offset the mortgage. You had to get a screaming deal, and it was more the exception than the rule. In Indianapolis, it's more the rule than the exception. On paper versus reality, this is a big one. A lot of investors get conned into properties that sound like a great deal. They've allegedly been rehabbed. They allegedly have tenants in them and are in supposedly good areas. However, when that tenant leaves 3 months into the lease or you have to evict somebody for whatever reason, what you played out on paper, what you were planning for on your rate of return goes in the tank. Indianapolis most consistently, out of all the markets we researched, turned in the results that we thought we would see on paper. And that's what you want. You want to be able to do some research, look at a market, look at a property, and have what actually comes into your checking account be close to what you thought you were going to get. Otherwise, it's very difficult to plan. The experts agree with us. 2 months ago, in June of 2011, Inman.com released an article, a very comprehensive study of the top 10 markets for real estate investors. They took into consideration things like forecasted population growth, the economy, the market share of foreclosures, the vacancy rate, the rental rates. And after all of that came in, they rated Indianapolis Carmel metropolitan area as the number one market for real estate investors. One thing I really like is that the population here in Indianapolis is forecasted to grow by 8% over the next 10 years. Anytime you own property in an area where population is forecasted to grow, where people are moving in instead of moving out, that's a good thing. With all the states that surround Indiana, they're experiencing higher than average unemployment rates, and in many cases people are actually leaving the state faster than they're arriving. Not the case in Indianapolis. One more thing to add before we wrap it up here. Many people assume that Indianapolis has an economy, has a culture similar to other areas in the Midwest, and to a degree that's true. However, Indianapolis's economy diversified a while ago and started to get away from that manufacturing-based economy, which was a good move because many of those jobs are ending up in China and India, and areas that have an overly dependent economy on manufacturing-based jobs are seeing horrible declines in their economy. Indianapolis went towards more of a medical, financial, and professional economy a while ago, and that's why it has remained stable. So that is why we like the market. I'm sure at this point you're wondering what the next step is. There's a few things that you can do. If you'd like to see a prospectus from us on why we like this market, see the research, see the data, go to indievisionequity.com/info. And down on the bottom of the page there, make sure you scroll all the way to the bottom, you can see a quick little registration area to submit your information and get this report. It comes to you electronically, you'll have it instantly. You'll also be subscribed to our list to be notified of available investment properties that Vision Equity is currently working on in the Indianapolis market. Another thing you can do is to email me at solson@indievisionequity.com for a recent history of Vision Equity's properties. You have to agree to keep it confidential between you and I because it does contain addresses and pictures of real properties that we've done for real investors. However, it'll give you a very comprehensive idea for the average purchase price, average rehab time, average rent amount, all that kind of stuff that you need to research as an investor. Or if you've got other questions and want to talk, feel free to give me a call at 317-202-1271. That's 317-202-1271. Thanks again for joining us as we talked about properties in Indianapolis today. We'll have more videos to come to educate you on the fantastic opportunity that we see here. Good luck and happy investing. Thank you.